We have such a phenomenally busy week of corporate news ahead of us, it's tempting to ignore the macroeconomic side of things altogether. But that's rarely a good idea when the US Federal Reserve is holding its latest policy meeting. Chair Jay Powell will reveal the American Central Bank's latest policy decision on Wednesday the 28th of April. In fairness, no change is expected, so watch for the Fed to leave its headline interest rate unchanged at 0.25%, and its quantitative easing or QE program running to the tune of $120 billion a month. That QE run rate leaves the Fed's current asset base at $7.8 trillion, a new record high and up by almost a quarter year on year. It also underpins the ongoing surge in US money supply, which some economists think could lead to the return of inflation, something the Fed actually seems to crave. Mr. Powell's recent speeches all seem to make it clear that the Federal Open Markets Committee will not rest until the US is nearing maximum employment and then inflation stands at its 2% target consistently. Indeed, the central bank is even saying it'll tolerate some inflation overshoot if those periods compensate for times when it undershoots the target. The more cynical also think the Fed will step in should financial markets suffer any unexpected tumble, although others argue that this blind faith in the so-called Fed put will eventually lead investors to take too much on trust, take too much risk and get into trouble. That's a decision that only you can make for yourself, according to your own personal investment strategy, time horizon, target returns, and appetite for risk. We're due a busy week in America on the corporate front as well, with names such as Alphabet, Texas Instruments, Apple, Facebook, Qualcomm, Microsoft, Amazon, Comcast, Caterpillar, ExxonMobil, and Chevron, to name but a few, all due to report quarterly results. But the US isn't going to be dominating here. The UK has got a very busy slate too, with nearly a third of the FTSE 100 due to release a trading statement, publish results, or host a virtual annual general meeting in the week ahead. There's a lengthy scheduled list of releases from mid and small caps too. Names which may be worthy of further note include the following, either because of what they say about themselves, their industry, or the economy more widely, although some of these dates could be subject to change. We've got Pearson on Monday the 26th of April, HSBC, Whitbread and Aviva on the 27th, Lloyds, British American Tobacco, GlaxoSmithKline, WPP, Persimmon, Sainsbury and Reckitt Benckiser on the 28th, Unilever, Glencore, NatWest, Flutter, Standard Chartered, DS Smith and Shell on the 29th, when broadcasters ITV and STV will get in on the act. And then deep breath, AstraZeneca, Barclays, Smurfit Kappa and Hikma will close out the week on Friday the 30th. But for all of that long list, the name which could just cause the biggest fuss in the week ahead is BP. The oil major is due to report first quarter results and no doubt give an update on its planned strategic shift in preparations for a net zero carbon future on Tuesday the 27th of April. Now what's interesting here is that BP shares are up by just 4% over the past year, even though the price of oil has more than trebled using Europe's Brent crude as a benchmark. In addition, natural gas, as measured by America's Henry Hub benchmark, well, that's up by almost 60%, and yet still, BP has barely budged. The first quarter results will therefore be the latest test of BP's strategy, and the first figure that will attract attention of analysts is output. This was down by almost a sixth year-on-year in the fourth quarter, including BP's share from Russia's Rosneft. Such supply-side discipline could help to set the tone for any recovery if and when oil demand picks up, and average oil prices received should be well above the $31.80 per barrel of oil equivalent received in the first quarter of last year, and that's measured in dollars. Now that should help to drive an improvement in profits from the upstream activities, oil exploration and production, even if the increase in input costs could crimp margins downstream, oil refining and petrol stations. A year ago, BP made a replacement cost profit from upstream of $1 billion and from downstream of $0.6 billion on the same basis. Total underlying replacement cost profit was $2.4 billion, even though changes in the value of inventory led the oil major to report a net loss of $4.4 billion in January to March 2020. After the headline numbers, analysts will home in on cash flow because it's cash flow that pays the still all-important dividend. BP halved its dividend in the second quarter of last year, cutting it to 5.25 US cents a quarter, where it stayed in the third and fourth periods. No changes expected in that run rate this year either, according to the analysts' consensus, and that would put the stock on a yield of 5%, assuming a 21 cents a share full-year dividend. Now, in cash terms, that comes to around $1.1 billion a quarter, and shareholders and analysts will be looking at how that is covered by cash flow, although in a worst case, BP could also use debt and asset disposals as a source of funding. BP did note some good news in early April when Mr. Looney, the chief executive, noted the firm had hit its target of getting net debt down to $35 billion, thanks to cash flow and the completion of its $10 billion asset disposal programme. That gives the firm a bit more room for manoeuvre when it comes to investing in its assets and paying dividends, while Mr. Looney's even hinted at share buybacks. Though quite why he's bothered there is a matter for debate, since $41 billion worth of share buybacks since 2005 don't seem to have done much for the share price over the long term. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.